I'm going to turn to business news. An international report out today has some advice for Canadian policymakers that could affect anyone with a mortgage or maybe a line of credit. The OECD says Canada should more than double its interest rate within the next 2 years. That would put an end to low-cost borrowing, and Gaviola is here with more. Why this unusual call at this time, Anne?
It is an unusual call. It raised quite a few eyebrows, actually. What the OECD, this think tank, is calling for is sort of a pause and then a pickup in economic growth here in Canada. And because of that, they're calling for our central bank to more than double its key lending rate to 2.25% by the end of 2015. They've looked into their crystal ball, and they're projecting a big pickup in exports as well as business investment. They see those as sort of the drivers of this growth for us. If this OECD prediction comes to fruition, then you can expect to see a hike in variable rate mortgages, higher fixed mortgage costs, and Canadians across the country have already seen what some are calling mortgage creep, those mortgage costs creeping higher in the summer. If this prediction comes to fruition, you can expect to see a lot more of that coming in the very near future.
And how likely is the Bank of Canada to pay attention to this report?
Think tanks aren't really the kind of thing that our central bank pays attention to. In fact, if you ask most of the economists on Bay Street, that's not the scenario that they see unfolding. They don't see the bank budging with its key interest rate until early 2015. A big part of that equation is that they have to move sort of in lockstep with what the U.S. Central Bank is doing. They haven't given us any indication that they're going to be increasing rates anytime soon. And also, inflation here in Canada isn't so hot that the bank has to step in to cool it off. So a lot of economists saying, how do you make the case for raising rates in that kind of an environment? Let's take a quick look, though, at where that rate stands. A lot of people, yes, we know that we've enjoyed sort of a very low borrowing rate environment for the last little while. It hasn't moved from 1% in the last 3 years since September 2010. And from all the signs that I've been looking at, it isn't likely to see a big shift from that in the near future.
Thank you, Anne.
You're welcome.
And by the way, we'll be back when North American markets open in about 20 minutes.